Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Hold on. We got a Supreme Court ruling. The Supreme Court allows emergency abortions in Idaho for now. And this was the case that if the woman's life was not in danger but was compromised, would it be legal for a doctor to wind up performing that abortion? It looks like the Supreme Court allows emergency abortions in Idaho for now. June Grasso is still sitting with us in the studio. June, give me your take.
So this is a sort of kick the can down the road decision, because what they're saying is that the case was improvidently granted. So it's dismissed because improvidently granted. We call it a dig. And that means that we shouldn't have taken the case in the first place. And the justices were split 3-3-3. So the three liberals thought that the federal law supersedes the Idaho state law. The three concurrences, which were the justices in the middle, this really shows you the setup of the court. The justice in the middle, the Chief Justice, Barrett and Kavanaugh, said we shouldn't go forward with this case. We should send it back. But they didn't endorse any particular theory. They said this case has changed since we got it. And the three in dissent, Alito, Thomas, and Gorsuch, said no. The state should have the right to say that you can't have abortions unless the mother's life is in danger. So the setup was really weird. Now it goes back to the Ninth Circuit, and there's more litigation. This could come up again, and the issue will come up again probably because Texas has a similar law, and the Fifth Circuit, which is so conservative, has not allowed the federal law to supersede the state law. So Justice Ketanji Brown Jackson wrote a really, I thought, compelling concurrence saying that, we're not making decisions here. We're just kicking. She actually said we're punting. Yeah. We're punting. So, and meanwhile, the people like doctors and women don't know what the rules are because we're not making them.
Okay, so that was my question. So if I'm a doctor in Idaho and I have a woman that comes to me in the emergency room who is ill, that I can help with an abortion, but she's not dying, can I do it or not?
Now you can do it. You couldn't do it yesterday.
But you can do it today.
But now you can do it today.
But maybe not in a month.
And that was one of the things that the Justice Kagan wrote about, that there has been so many problems on the ground. Women have had to be flown out because doctors, this is criminal penalties for doctors up to 5 years. So doctors were afraid to make the decision, is this woman, is her life in jeopardy or not?
Or women had to wait until they went into like septic shock in order to get the treatment.
And even Justice Barrett, who is very conservative on the issue of abortion, talked about that. What about sepsis and things? So, and what was funny in the arguments were the women on the court were so much in tune with what was happening on the ground. And here you have Alito. Well, he's talking about there's a two words in the statute, unborn child, and if you put it in context, it doesn't mean the fetus should, but his dissent is all about, it says unborn child, so it's more along the lines of what he wrote in the Dobbs decision. That's all I'll say.
What's the next thing from the courts on this abortion issue? Are there other cases? Because this one, as it kicked the can down the road, it's a punting type scenario. So it feels like we're just going to be bouncing back and forth between the states and the federal Supreme Court.
And that's why anyone who thought that, what Justice Kavanaugh wrote in the Dobbs decision was, okay, we're done with this now. Abortion, the issue is for the states. And that's just too simple, and it doesn't work in real life. So here, 2 years after that, we have two cases dealing with this, and both of them, if you think about it, both of them kicked the can down the road, because the mifepristone case, they went off on the procedural issue of standing, so that's coming back too.
Oh yeah. All right, June, we really appreciate it. Thank you so much, June Grasso. No doubt will be sitting here with me while Paul's at the beach. She'll be here with me tomorrow at 10 a.m. I was just introducing Nathan Dean as we got this ruling. He's senior policy analyst over at Bloomberg Intelligence, and I was asking you, Nathan, about the presidential debate tonight. Who sits in the White House and who is in the Senate is critical for who is on the Supreme Court, for example. And these kind of decisions make it all the more important on who's going to be sitting in the White House. The expectation game is key. How have President Trump and President Biden set the expectations going into tonight at 9 p.m.?
So I think every candidate that goes into a presidential debate going back the last 15 years always tries to underperform, or at least announce in advance that they're going to, keep expectations low, because then if they perform well, then it just seems that much greater. But there's really two things that we are telling our investors or clients to look at too. Is the first is just the fear of the headline risk. Assuming that there are policy debates tonight at the debate, if you see something like President Trump double down on his statement of a 60% tariff on all goods coming from China, well, that's already been baked into the market, but anticipate a headline risk tomorrow. The other thing is that any statement from either President Biden or President Trump to saying, I'm going to do this or I'm going to do that, always just remember to put on, how is this going to get through Washington hat on? Is it going to be executive order, regulation, legislation? And a lot of times that statement just doesn't actually equate to the reality of the situation, where they can say lots of things, but depending on how the Congress plays out and how the regulators play out, ultimately the impact could be much less.
What do you think investors should focus on the most in this debate here, policy-wise?
So there's two things. The first is the geopolitical aspect, because the power of the presidency is a lot more powerful when it comes to geopolitical, national security, and trade. So any statement from President Trump or President Biden on Ukraine, Taiwan, tariffs, or so forth like that certainly should be paid attention to and then put in the back of your brain as we get closer to the election, because more statements will come. The other is tax related, because the Trump era tax cuts from 2017 expire for individuals at the end of 2025. So no matter who wins as president, the House and Ways and Means Committee and the presidency is going to be focused on tax next year. Now, it's going to be individual, and I think for most individuals, their tax rate is not going to go up. But if you're exposed to EVs, like if you have investments in Rivian or Tesla, for example, that could come up under a Trump presidency. High net worth individuals could see higher taxes under a Biden presidency. So next year is definitely going to be about tax, and something to pay attention to tonight.
Which is so interesting, because a lot of the argument is like, oh, well, what they say on that campaign trail is not going to actually materialize, or it'll be sort of, muted, or it won't actually wind up happening, which makes it so hard for investors to understand how to price any of this. What's your best recommendation here?
So I view it as just an incremental step. So if you think of like if you think that President Trump or President Biden comes out at a high level and says, like, I want to do this, but over time, the expectations lower and so forth, you'll get additional information as they go through the campaign trail. Look, tonight's debate is not going to set the stone in anything in terms of policy, but statement tonight plus a statement tomorrow plus a statement at the next debate, so forth, you'll begin to get a better picture of what ultimately could happen. So I'm not going to say that, you're going to see massive headlines tomorrow saying the markets are moving based off of this, but we've told a lot of our clients, if you have an associate that wants to stay up late tonight, have the association take a look at it, watch this, and then send you a report in the morning.
All right. You can send me my report. You've got my email address, because I'm not staying up watching this. I don't think the Yankees are on anyway. Nathan Dean.
But you're off tomorrow. You technically can.
You're right. Hey, thank you for pointing that out.
You're
I don't
welcome.
have to get up at 4:20 tomorrow. Okay, very good. Nathan Dean, Senior Policy Analyst for Bloomberg Intelligence. He's down there in D.C. for better or worse. That's where he's located here. So are you going to watch the debate tonight?
Oof. Yes, no?
Yes,
I mean,
no.
I don't want to, but
I feel
I
like I
want
have
to,
to,
and
yeah.
I feel like I have to.
Although, with the ground rules, no audience, the muted mics, it's not going to be as much drama as it could be, which is why I think some people would watch it just for the drama.
Maybe. But I am actually interested, if any kind of policy is actually discussed. Like,
Right.
if it's just going to be barbs thrown back and forth.
I can tell you who the loser's going to be.
Jake
Intelligent
Tapper at
discourse.
CNN?
Intelligent
No,
discourse.
I don't know. Yes, I'll probably turn it on.
Okay.
Until
All
we
right,
have
very
family reading time at around 9:30.
Family reading
I'll
time.
give it half an hour.
Okay.
I'll give it half an hour, and then we'll circle back before that family reading.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast. We got a new guy in here today, a new guy. We'll
Yes.
see how he does. Jake Silverman joins us
Don't
here.
worry, Jake. It's going to be fine. Don't let Paul scare you.
He's an analyst at Bloomberg Intelligence. I did not hire him, so I can't vouch for him. Hired everybody else. He covers the technology space. We got a great technology team all around the world. Everywhere you need tech people to be. Silicon Valley, Asia, New York, we got them as well. Micron Technologies, the largest U.S. maker of computer memory chips, as John Tucker was just reporting, dropped after its forecast disappointed investors. So we got an issue there about this chip maker. Jake, thanks so much for joining us here in studio. Give us the Micron Technology story. How were their earnings? Why is the stock trading where it is?
Yeah, thanks so much for having me on. Yeah, so 3Q was a beat, but the stock's up over 60%, or prior to earnings was up over 60% year to date. So coming into the quarter, expectations were fairly high. And so when we've seen a beat and raise as pricing has improved, supply has been pretty tight intentionally by all of the memory suppliers over the last year or so, because there was a severe demand reduction back in 2023. And now as we're looking into 2024, supply is tight, demand has stabilized, now is beginning to recover quarter to quarter. So investors, the market was really expecting another beat and raise, I think, coming into 3Q with the outlook being related to 4Q. So it being a sort of inline guide, at least on revenue, I think was pretty disappointing. And then you also have the AI aspect, which I think adds to a little bit of that multiple expansion that we're seeing. And so I think that plays a part into those expectations as well.
If we just separate for a second, if we can, like you have the AI growth story, which still was delivering on like all cylinders for Micron. And then there's the actual boring stuff, like the things that go into your phone and your computer and things like that. That market has been, has troughed, but the pickup is when the question is, do we learn anything about when we might see a real recovery in that? Because Micron still needs that, right?
Yeah, so that was actually what was more important about the tight supply story from 2023 up until now, and then continuing through the rest of this year and probably into next year as well. The AI part of the story was pretty nascent up until more recently, and we're still only now starting to see AI revenue actually inflect. High bandwidth memory revenue for HBM3E, their product that's being sold into NVIDIA's H200 GPU, that was only about a little more than 100 million this quarter. So there's other AI products as well, but yeah, we're starting to see demand, I think, stabilizing for smartphones, PCs, traditional servers, and we're expecting some growth throughout the rest of this year, primarily on the back of seasonal demand. So yeah, I think that those are definitely areas that investors are certainly going to be looking for. And if that demand doesn't necessarily materialize, then the pricing might not increase at the magnitude at which the market is expecting, which would impact revenue and margin growth throughout the rest of this year.
I don't know a lot about the semiconductor business, and I want to keep it that way. But what I do know is it's a cyclical business, and you got to get those cycles right.
Yes.
Does AI change the cyclicality? Do you think? Do we know enough to say that maybe it'll make it less cyclical or maybe more cyclical?
So yeah, it's a very good question. It's difficult to say right now. I think because this AI build out for AI infrastructure, it's so early. So we don't really know what that cycle will look like. But this is certainly a secular driver in the near term. AI infrastructure build outs from the hyperscalers are continuing. There's potentially some upward bias to those estimates and those expenditures this year. And so as long as that continues, that should have a multi-fold impact on Micron, because there's another aspect, which is, first of all, there's a couple aspects. First of all, HBM is margin accretive. And some of those other products that are related to AI are also margin accretive. So talking about high capacity DRAM modules, solid state drives, but HBM more so. But also HBM takes up additional wafer capacity.
High bandwidth memory, yeah?
Yes,
okay.
Yes, high bandwidth memory, sorry, HBM. But that also takes up wafer.
It took me like 10 minutes to remember that, so we don't want to
good,
say
though.
nice.
Yeah, sorry, I go in and out of HBM, high
Sorry, go
bandwidth
ahead.
memory. No, thank you. But also it takes up additional wafer capacity for high bandwidth memory. So about 3 times as much. So that actually, as you shift capacity away from standard memory towards HBM, that has a specific impact on the actual supply allocation. So as that demand continues to increase, that actually takes supply away from traditional markets as well. So ultimately you have a twofold impact where you have margin expansion, but you also have pricing probably increasing, even if demand is somewhat stable, because the supply comes offline from traditional end markets and goes towards AI.
Well, also to the cyclical point too, as long as AI chips keep getting better and better with each iteration, doesn't that take away some of the near-term cyclicality? Like, because by the time you get your old chip, then the new chip is like that much more awesome, so then you have to go buy it, and at some point that runs out.
So it's difficult to determine actually what the magnitude of the cyclicality will be up or down. I think what this is really going to do right now, at least in the near term, will extend the current up cycle. So the peak is difficult to determine when that will happen. I mean, you can always guess. I don't think people are very accurate at guessing peaks and troughs, at least multiple quarters out. But in this case, as long as there's those secular demand drivers, we think the cycle can continue its upward trajectory.
Jake, great stuff.
Yeah,
we can bring him back, right?
Oh yeah, he was great.
Yeah,
he was really good. Yeah,
excellent.
yeah.
Another tech voice which we desperately need, because we can't keep going back to Mandeep and On a Rock.
I mean,
boring.
They have other jobs.
Yeah,
they have day
thank
jobs.
you so much, guys.
Yeah. All right, Jake Silverman, Semiconductor Analyst at Bloomberg Intelligence, joining us here on our Bloomberg Interactive Broker Studio, talking about the chip business.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now is Kate Richards, founder and CEO of Warwick Investment Group. So Warwick Investment is the largest PE firm in the U.S. that's founded and led by a woman founder, and it focuses on real assets like natural resources and real estate. I've known Kate for a long while, it feels, but I haven't seen you in forever and a day. How are you?
Great, thanks for having me. I think that the fact that I haven't seen you is probably sort of reflective of what most people haven't seen, which is commodities in their portfolio over the past decade.
Oh, way to turn that in. I like this. So what we're seeing in the trend is, people want to own commodities in their portfolio, but like not all commodities, but be very specific. But we also seen a ton of M&A. Big guys with the medium guys with medium guys, small guys and small guys. How do you think this winds up playing out, and what are the opportunities set for you?
I think two things. So number one, we're probably at the beginning of a new commodity price super cycle. And the first one was 2000 to 2015, driven by urbanization and industrialization in China. This one's driven by the energy transition. And what's ironic is that it's obviously increasing demand for battery metals like nickel, lithium, copper, maybe cobalt. And secondly, that it's actually increasing demand for hydrocarbons because the energy transition is hydrocarbon intensive. And if you need any evidence of that, you can look at what happened with China last year, the largest EV market in the world, where hydrocarbon demand actually went up. And so the cautionary tale is looking at gasoline demand trends, which in China went down last year, and equating that to price trajectory for oil or demand for oil. So I think that's really something that's important. It's a subtlety, but whatever's happening with EVs and whatever's happening with gasoline trends because of EV adoption, you can't relate to the price of oil or demand for oil. And but even that being said, oil and gasoline were at all-time highs in terms of demand last year.
Well, Alix, as you know, is an energy expert. I am not. What's your view of this energy transition? Because it seems like, if I think about EVs, it's kind of taken a tick down a little bit over the last couple of years. How do you guys view that?
Well, I think that, we deal in communities that don't want to talk about energy transition at all. And then on the mining side of our life, we deal in communities that will not talk about hydrocarbons as an ongoing source of energy in the world. And both of those are unrealistic. We talk about energy as kaleidoscopic, and you will have certain jurisdictions like the East Coast, the West Coast of the US, the OECD, certainly Europe, that will skew more renewable in terms of power and more EV in terms of vehicles. And then you will have groups that do not. And I think the problem is that in sitting in the OECD and reading all of the kind of typical, like, New York Times, Wall Street Journal, FT, Economist, maybe Bloomberg, Axios, you sort of think like, oh, the energy transition is happening and conventional vehicles and conventional fuels are going out of business. The problem is that if you look at the last 22 years, the OECD, which is about 400 million people, has taken demand for hydrocarbons down 2 million barrels a day. And the non-OECD has taken hydrocarbon demand up 25 million barrels a day. So it's just a law of large numbers. And the fact is that if you wanted to say no traditional energy, that's unrealistic. We don't have enough copper in the
Yep.
world to supply that. But if you wanted to say no renewables, we don't have enough oil or LNG to supply the world. So it has to be kaleidoscopic, and it's really an all of the above energy solution, including nuclear, which last year came into the conversation
Go
as
there.
carbon free.
Kaleidoscopic. I'm
I like
totally
that.
stealing this
Yes.
one. Yeah. So Kate, when we have this interest though in the energy space among energy companies, does that make exit strategies more appealing for you? Like, are you buying more or are you selling more right now? Because for a while it felt like assets in private equity when it related to energy was stuck. It was going nowhere fast.
So in 2018, we had a number of oil and gas companies. One could probably argue too many in the U.S. 60% of the oil and gas companies that existed in 2018 don't exist today because of M&A. So there has been massive consolidation
that
in this
one.
space. And we're probably not going back to the 70s where it was like the 7 sisters, 7 big companies, but we might be going back to 15 companies. So definitely there is consolidation. And that consolidation was localized in the Permian Basin in West Texas until this year. And I would say now the Permian's pretty consolidated, and now it's going to other basins in the U.S. So this is sort of a cross-basin U.S. consolidation story. That's number one. Number two, it's definitely cheaper to buy assets. So 2014, 15, we would pay 7 to 10 times EBITDA. We're buying assets now for 1 to 3 times EBITDA.
But doesn't that mean that you're doesn't that mean that you're selling assets for that too though?
It does not mean that, because in a lot of cases people need to pay for inventory. Because the reason, like to your point, why are the mid caps buying small caps, or why are the small caps trying to buy, like why is this game of Pac-Man happening where it's either get consolidated or consolidate? It's because people are short inventory. So in your private portfolio, if you have inventory, or if you're a public company you have inventory, you are attractive, and it's a game to get bigger before all of the chips are sort of held by big public companies.
You mentioned nuclear. What is a reasonable nuclear policy from your perspective? Because I'm hearing more about the technology changing now. We don't have to build these monster reactors. We can build
SMRs.
little ones. And
Yeah.
that seems reasonable to me.
So I actually think there's a really interesting fight that's sort of like brewing between big tech and LNG exporters, frankly, because big tech knows that they are massive power consumers and
Yep.
they need power quickly, especially if you're sort of positing that it's like this AI fight nationally that's in national interest. So if you talk to big tech, they'll say, AI ushers in a nuclear renaissance, and it's not that hard because we have these small modular nuclear reactors. This is an existing technology. It's on submarines all over the world. The fact is, you'll probably see some of that, but you'll also probably see some of it go to natural gas and some more go to renewables. I think that big tech is probably going to have to embrace like a kaleidoscopic power outlook.
We haven't put any nuclear plants in operation
No,
forever,
we haven't.
right?
Right, yeah.
So to say I'm going to power this data center with a small nuclear plant, that is a huge deal.
Yeah. There's also probably not the uranium to power a nuclear renaissance right now, particularly with the House and Senate now restricting 20% of the uranium market to be imported into the U.S. And that matters because the U.S. is the largest consumer of uranium, and we are now, like as of 2027 or 2028, not allowed to buy uranium from Kazakhstan or Russia.
So yeah, but to your point, Paul, they are considering restarting a nuclear plant that was closed. That's quite big. And the SMRs, these small modular reactors, they're just, the economics are so wide. Like you just can't make the economics work yet.
Okay.
But I like that you brought up the uranium factor, because what we are seeing is oil companies go into mining, particularly with lithium. And I'm wondering if there's a way that you are thinking about your oil and your real play, like the hard asset plays. Are there plays for you there?
Yeah, I think, for definitely. So oil and gas companies are actively looking at lithium because we extract lithium when we bring water out of the ground in saltwater brine across the U.S. So that is definitely a play. The other thing is that a lot of the mining companies don't know how to lease acreage to do mined expansion, and that's something that oil and gas companies are very good at. So I actually think you're seeing this merger of the natural resources brethren in a lot of ways. And the similarities are fascinating because mining and oil and gas globally have both decreased CapEx 40% since the 2013-2014 timeframe, and mining and oil and gas companies also are only spending 40% of cash flow on CapEx today, and they're both essential for the energy transition. So I think you're probably going to start to see a lot more intersection of conversation around oil and gas and mining companies, just as these natural resources businesses that haven't really been super relevant for the past 10 years but are increasingly very relevant.
Cool, right?
Wow.
Super cool.
Very good. Very
Kate,
good.
appreciate it. So don't be a stranger. You don't have to be here to do this. So we can definitely chat remotely as well. Kate Richard, founder and CEO of Warwick Investment Group. It's sort of how do you make money in the energy transition and how that's going to wind up playing out and where the supply shortfall is going to be. And Paul, what's so interesting is we talk about oil reduction use, particularly in developed nations. It doesn't mean it's going to zero. And right. I feel like that's a reset a little bit. Like it can decline, but we're still using it. It's not like we're going to nothing.
Okay. I mean, it's going to be a kaleidoscopic solution.
I'm never going to be able to say that word again. Kaleidoscopic. Tucker,
Yes.
Did you look it up? Did you have time?
It sounds too much like colonoscopy, so I'm going to avoid it.
Well, now you're messing me up. I'm never going to. It does not sound like colonoscopy.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Walgreens boots, disappointing results. Stock down 23% here, 52-week low, the lowest since 1997. So big move there. Let's bring in Jonathan Palmer. He follows all this stuff for Bloomberg Intelligence. Jonathan, what's going on with our friends at Walgreens boots?
Well, I think you can see from the stock reaction, nothing good is happening these days. I mean, the CEO came in last year and there was a little bit of a halo effect on his hiring. I think that halo has dissipated and investors were expecting more sooner. And it looks like, this is structurally going to be handicapped for at least another year. I mean, they talked about 75 cents of headwinds going into their fiscal 2025. I mean, if you rewind a couple years ago before the pandemic, this was a company that was earning $6 a share. Now it looks like next year it's going to be more like $2 a share. So investors are frustrated with waiting for the turnaround, and it looks like it's even extended further in the future here.
So what part of this is a Walgreens issue versus a macro issue?
Well, a little bit of both. I mean, they were very particular about calling out consumer weakness as one of the drivers for the downside this year. But really, it's, I think, more of a structural issue in the pharmacy space. They've been being pressured by insurers and payers for a number of years, and that doesn't look to dissipate. And so they're thinking, they and others like CVS are thinking about new models for pharmacy reimbursement, but they're just between a rock and a hard place here.
Jonathan, how much of this 23% decline in Walgreens is a company-specific issue or more of an industry issue?
I think it's more company-specific here versus industry-wide. I mean, CVS has been doing okay in their pharmacy. They face the same structural challenges around reimbursement, what's going on in retail. Here, it's just, they glossed over some of those woes during the pandemic. They had a big sales leaseback program with their stores, which has now come to an end. And so they've been looking for ways to grow the company. They bought VillageMD a couple of years ago, and it sounds like now they don't really want to be involved with that asset anymore. And so they undertook a strategic review. I think investors were anticipating that maybe they would sell their Boots assets abroad. They would maybe do some sort of new deal with VillageMD, and none of that's come to pass. So the wait is on for the turnaround, and there's no real inflection point in sight here.
Okay, so if that's the case, I mean, I'm going to ask you how low can we go? But what is then a reasonable valuation for a stock like Walgreens where we don't actually know what the trough looks like?
Yeah, I mean, I think they're getting to the trough in terms of EPS and that multiple. I think you can look back and single-digit multiples don't usually stick around for that long, particularly with where the S&P is trading. So, from a valuation perspective and an earnings trough perspective, I think we're close to the bottom here. Maybe not the absolute bottom. There might be a little bit more to go, but it's hard for me to envision given what they're doing around these store closures, around monetizing some of these assets, that they haven't, kind of gotten to the worst of their earnings power here.
All right, Jonathan, thank you so much. We appreciate that. Getting the latest on the Walgreens Boots situation, stock down 23%. Jonathan Palmer, he covers all that healthcare stuff and all the pharmacies and all that great stuff for Bloomberg Intelligence. Appreciate getting a couple minutes of his time.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio right in Midtown Manhattan. We're also streaming live on that internet thing. I think you go to youtube.com and search Bloomberg Podcast, and that's where you will find us. Joining us right now is the pride of Southwestern Virginia by way of London, England, Tim Craighead, Global Chief Content Officer for Bloomberg Intelligence, joining us from Zoom from our global London headquarters, Queen Victoria Street in London, extraordinary building right in the city of London. Tim, thanks so much for joining us here. I know you guys at BI, you put out your research here on some 10 companies we need to watch periodically throughout the year here. We've got one you guys recently published about the companies to watch in 3Q. Give us a couple of names that we should be really taking a look at here as we approach third quarter earnings.
Yeah, absolutely. So I'll give you a smidge of a backdrop on this, if that's okay, to put it into context. These are all part of what we call our focus ideas, which is a list of companies that we have a strong point of view on fundamentally that we think is different from what the market currently believes, and there's catalyst ahead to hopefully turn the market towards our view. The thing that sets these 10 off is that they all have catalysts coming up in the third quarter, a la the 10 companies to watch for this quarter. And I guess the first group that you have to start, it seems like with any conversation these days, is AI. And there's certainly a couple of AI-related ideas here, even though NVIDIA is not on the list. Corning.
Ooh, interesting.
This fiber optic cable. You can't have AI going through all of these data centers if you can't connect the data centers together. And interestingly, with fiber optic cable, there was actually a down cycle over the course of the past year where there was excess inventory and this, that, and the other with some telco build related to 5G. That sort of is worked its way through, and we expect data center build out to really drive demand for fiber optic cables going forward, a la the potential for positive surprise. There's another one called THK. My guess is you've never heard of this one. Yeah. It's a machinery company out of Japan, and they have a 50% share in something called, now I'm going to make sure I pronounce it correctly, linear motion guide rails. And you're saying, good. What? Yeah. If you think about how you picture semiconductors being manufactured, there's the equipment that buzzes across and etches these patterns into silicon. The rails that they run on are these things, and they have a 50% share.
I love this kind of stuff. Yep. It's like the guts of the things.
Yep.
Yeah, so these are things that you can't do AI unless you have these things. Mm-hmm. So we're looking for those types of opportunities. You could draw a little bit of a further sort of second or third degree connection with Sandvik. This is another machinery company based in Scandinavia. 50% of their business is mining related, and you're saying, what? Well, the current hot topics these days in mining, among others, is copper. Mm-hmm. And we're seeing a CapEx cycle in copper. You can't dig and mine copper without Sandvik's stuff. So it's another adjunct play on AI. So those are a couple of things.
I like this. I mean, I like the way you guys are thinking about this, kind of by the, kind of the tools of AI as opposed to, kind of the direct plays here. Another one is I think about the Olympics in Paris this summer. Mm-hmm. And I think it's going to be just a monster event. Fingers crossed everything goes well. But that's good for all the companies associated with the Olympics. You've got one here, Nike. Talk to us about that.
Yep. Yeah, so Nike is interesting on a couple of fronts. You've got not only the Olympics coming up, but if you're at all into what they call football here in London, we would call soccer, obviously. The Euros are going on right now, which is a massive
Is England still in the Euros?
They are, okay. But they drew 2 of their first 3 matches, so they make it into the second round, but we'll see.
Okay.
But Nike not only has that to look forward to, but more importantly, they've got new product that's going to be displayed there and promoted there with all the advertisement and visibility that happens. Running shoes like the new Pegasus, there's other products as well. They've lagged for 2 years in innovation, and Puma and Adidas have taken share. You might remember we've talked about Adidas before, where we had a focus idea that Poonam Goyal was behind.
Mm-hmm.
She's since closed that, shifted gears towards Nike because she sees market share recovery with Nike because they finally got on board with some new innovation. So interesting story there. And I would say similarly, you could kind of throw into the same bucket Galaxy, which is one of the big casino operators in Macau, who, think about innovation and new product. They opened a big new phase of their Cotai-based resort. And they're starting to gain market share. And summer is the big season for travel. China travel is back up. And there's a big story there that, again, revolves around new product, innovation, right time, right place.
So what you also have on the list, which is interesting, is RH. This is Restoration Hardware. Is that what this is?
Yes, it is.
Okay, because the quarter wasn't that good, right? And their stuff is so expensive that in a downturn that feels a little hard to swallow.
You can't buy it on a discount? You can't get a sale at
Okay,
RH?
even the outlet store at Industry City, which is, they've outlet stores in Brooklyn and stuff, is just insanely expensive for something that's super boring.
Quality. I've purchased some of their stuff.
Well, sure, but you can get something for good quality that's not going to be like $8,000 for like a table. I don't know.
Well, so
you know how I roll
playing
here, people.
You're playing into the idea here, Alix, and I am going to date myself. I remember being a equity research salesperson back at Goldman on the day, and we were doing the IPO for Restoration Hardware. I remember traveling around with management, but that's another story. RH is one of our cautious ideas, along with HCA, the big U.S. hospital company, as well as Nintendo, the gaming software electronics company. We do have negative focus ideas as well as positive focus ideas. And the thing with RH, management guidance and still consensus is guiding for recovery from what you're just talking about. But notwithstanding the resilient U.S. consumer, we still expect the recovery that's anticipated to disappoint. Furniture sales last year were disappointing, notwithstanding the consumer. And we think a recovery is going to be delayed and expectations are going to be cut again. So that's that one.
That's a little bit on the cautious side, right? Yep. Okay.
Yes, indeed. I would throw out similarly in terms of, we think, overly optimistic expectations. Nintendo, obviously totally different story, but we all know Game Boy and Switch and things like that.
Game Boy.
Yeah, going back in the day. But their current console is the Switch, and there is a new console coming out called Switch 2. And Paul, from your background, these console stories are big deals, whether it be for Nintendo or Microsoft or what have you. This one is sort of like Waiting for Godot. We thought we've been thinking they were going to announce a date, but it still is yet to come, and we think it causes room for disappointment relative to where consensus expectations are still setting.
All right, very good. As always, so Tim's an American, but he has adapted to this whole English bank holiday thing.
Okay.
They have a lot of bank holidays in England, so they get the days off for seemingly no reason, and then the whole month of August, forget about it.
Yeah.
So again, Tim's a good boy from southwestern Virginia, but he's all in on this whole European vacation thing. Tim Craighead, thanks for joining us. Tim Craighead, Global Chief Content Officer, Bloomberg Intelligence, joining us from our Queen Victoria Street offices in London. So good stuff there. Some good ideas coming out of BI, kind of geared around maybe where they think the street isn't in terms of viewing some of these names.
So my daughter wants Nintendo Switch. Do we like this? We don't like this, right?
Stay away from video
games, right?
As long as you can.
Yeah,
That's
we
what
did
I'm
it as long as we could, but we kind of caved.
You did cave.
Yeah. Although that's good now because I got 2 boys who communicate primarily via the games and playing games together. And it was, oh yeah, I talked to him, my brother Jordan, yesterday. We were playing games for an hour, and I was like, oh, okay. So at least,
So that kind of counts.
yeah, I'll give it a little bit of a
I don't know. It is stressful.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.